Okay. What is going on, guys? Welcome to Stock Talk with Nico Criticos. Today we're going to do some stock analysis on Celsius stock. This stock hit a high of $65 a share last October. Now we're down to 41, and it seems like some of the hype has died from this stock. And so we're going to see, is this a good time to get in and what's going on with Celsius? So Celsius is the number three player for energy drinks. I believe they own about 20% market share. They also acquired Rockstar and Alani energy drinks. So keep that in mind as well. First thing I want to go through is some analysis from Gemini here, and we're going to find out, do they actually have a moat, or how are they going to compete with Red Bull and Monster? So the most important development in the last 18 months is the strategic energy drink captain for Pepsi. Okay, in most stores, the category captain, usually the brand with the most influence, gets to decide how the shelf is organized. Now they manage the shelf space for itself, Alani and Rockstar, which helps them beat out other fitness brands like Ghost or C4. Then we also have the fact that Celsius played a very important role in bringing the female market into the energy drink market, because prior to that, it was mostly Red Bull and Monster targeting men for extreme sports and all this other stuff. But Celsius has about a 50-50 gender split, whereas most energy drinks were often at least 65%. Um, Celsius has kind of marketed itself as a lifestyle and thermogenic calorie burning supplement rather than just a caffeine hit, which helped capture females as a new demographic. The Alani new defense, by acquiring the distribution rights for Alani, Celsius has effectively cornered the female energy market, making it very hard for Monster or Red Bull. Then we have the fact that Celsius also has been good at marketing zero sugar, and 33% of all growth in the zero sugar energy category is made up from Celsius. Okay. Then we come down here, and again, they have about a 20% market share, rivaling Monster at 30%, Red Bull at 35%. The big things here is that while North America may be saturated, which there definitely is a lot of players out there, Celsius is just getting started globally. International sales are currently only 45% of their 4 to 5%, not 45, but 4 to 5% of the revenue, whereas Red Bull gets the majority of its revenue outside the US. Celsius aggressively entered Spain, France, and Australia. And what else? Again, since they partner with Pepsi now, they have that distribution network, which is going to be a huge thing. And the fact that they own, three of the most popular energy drink brands, I think that puts them in a pretty good spot to compete, even with Red Bull and Monster. But for them to take over that number one or number two spot, it's going to be a huge thing. It's going to be very hard to defeat Red Bull or Monster, but we will see. Monster and Red Bull are often seen as work or gaming drinks. Celsius is trying to move into meal times. They are partnering with fast casual chains like Jersey Mike's and high-end gyms. So that's an interesting way to look at it too. Then we're gonna come over here to Qualtrim and take a look at their numbers. As you can see, revenue the last 3 quarters skyrocketed, which is probably because of not the partnerships, the companies they acquired. But still, that's a good sign. So you don't want to have to just acquire companies for growth. They definitely should not be at that stage at all. They definitely should have plenty of organic growth to go. And like they said, the international sales in other countries, that should be a huge catalyst for them. But trailing 12 last year, they did $2.5 billion in sales. It's a $10 billion company. So we're looking at 4.2 price to sales. Then we come over to net income, free cash flow. Both numbers are okay. Keep in mind, just a couple of years ago, they had negative numbers, and now they're at least doing $100 million of income last year, which is not that great. That means you're paying, over 100. It means you're paying 100 times earnings if it's a $10 billion company. So keep that in mind. Free cash flow is a little bit higher at 320 million, which is nice. Still, though, I mean, those numbers, I mean, their sales are growing, though. It's just that they're having to reinvest back into the business. They're acquiring new companies. That's why their cash went down big time. Their debt went up. Another not a great sign. At least, well, wait a second. How is that possible? Shares outstanding 25%. That's not what it looks like. Let me check. Let me double check this on an annual basis. So, shares outstanding is pretty much flat. Yeah, I don't know why it said that. But so that's good. They could be diluting shareholders, and they're not. Then we come over here to return on capital. We're looking at only 4%, profit margin of 4%, nothing great. Valuation metrics, very important to look at this. Past 2 years of price to earnings, it's kind of on the cheaper. I mean, it's not like it was, but it's kind of on the cheaper side. I don't know if I would call it cheap though. It's more just like average. See, I mean, 200 times earnings is not that's not good. This is where things look better. Free cash flow yield of 3.5%, the highest it's been in since what? The highest it's been since about a little over a year ago. So again, nothing amazing, but still okay. And price to sales does look a lot cheaper than anywhere it's been in the last couple of years. So that's good. Price to sales of 4. So I don't know. I don't know if I'm going to buy this right now, but I would say I feel like this could be a good pick. I think this could be a good pick. So that's my stock analysis for Celsius.